All right, good morning, everyone. It is 9:04 on the morning of July 15th, 2022, and this is my pre-market strategy session. So, the past couple of days have been pretty interesting here. The PPI, CPI, and PPI reported on Wednesday and Thursday. So, here's the Wednesday candle here. The Qs opened up down here around 280 and then closed at about 285 after making a high of 287. And then PPI came out yesterday and opened up at about 283, dipped down to about where the low was on the previous day, and then spent the rest of the day drifting up. So there's a bearish morning activity, which, fortunately I was able to capitalize on that. However, I wasn't able to capitalize as much as I thought I'd be able to, being that PPI came in much hotter than expected. And, at least I was able to profit on it, right? So now we have, and then the rest of the day, just spent the rest of the day just going up yesterday, really, a couple of pullbacks, but throughout the day it was really worth buying the dips, that's for sure. So, and now here we are this morning. If we opened up right now, we would gap up by almost a percentage point, by 0.93%, right here at just over 289 a share on the Qs. So it's looking to me like there's a bear flag setting up, and so here we have. And some people will see it as a triangle. Like there's definitely a distinct bottom here. Let's see, let's put it in right here, and then here, and then there's this leg of the triangle right here. Let's put this one in, I don't know, put it right there to right there, put it right there. So we're coming into this triangle. I don't know. I mean, I kind of prefer bear flags and bull flags. I mean, triangles, they break out. They break out. And there's no telling which way they'll break out. Whether they break up or down, there's really no telling. And so what I prefer is bear flags because there's no real. I mean, there is an entry in bear flags, but anyway, and the reason that I think the reason I'm still bearish is, well, one, because I have a consultancy firm that I've hired in order to forecast the economy and all sorts of market behavior and everything, and also the inverted yield curve. I don't know if you're out there and you're aware of this. Look at this yield curve right here. This is the 10-year minus the 2-year. You can see up here, TNX minus USO2, or you can see in the backdrop, the watermark back here, TNX minus USO2Y. So it's the 10-year yield minus the 2-year yield, and it's inverted. It's very heavily inverted. In fact, while I was on vacation, and then when I took a week off after that, it found some support there, bobbled around it for a bit. Now is breaking down into inversion, and an inverted yield curve has predicted a recession, U.S. recession, a number of times. And I don't know. I think out of the 14 times the yield curve went negative, there have been 12 recessions following up. Now, I'm not a big, I don't really care about recessions anymore because it's more about quad behavior, about growth and inflation. But, essentially, let's go back to late 2019 here. Here we go. Here's 2019. May 2019, and then August 2019, September. This is interesting. and the reason that this is interesting is because the yield curve started to invert. In fact, back here, if I remember correctly, the 30-year and the 3-year, I'd have to go back and really look at the rates here. I don't know if I want to do it right now. But if I remember correctly, like the 30-year and the 3-year, this is the 10-year and the 2-year, but the 30-year and the 3-year, or 30-year and the 3-month, 30-year and the 3-month were inverted really heavily, like big time, before the 10-year and the 2-year. Everybody was waiting for the 10-year and the 2-year to come up and turn negative as far as yields are concerned, yield spread. Well, anyway, what followed this was really quite coincidentally COVID, and so it kind of saved the market right in here. We were looking at a rather horrible recession back here at the end of 19, the beginning of 2020, and really quite fortunately, the sort of pandemic situation helped out, and there was a lot of money pumped into the economy to sort of aid the recovery from what would have otherwise been just a natural business cycle and debt cycle that were converging. So here we are now, and there's really nothing coming, no sort of government stimulus or Federal Reserve action that's going to come and save the markets this time. I mean, unless something else pops up, like, God, I don't even want to speculate on what would pop up that would cause the U.S. government to pass stimulus and for the Federal Reserve to drop its tightening cycle. I'd hate to even speculate what that could be, because it would have to be something just horrible. But anyway, for the time being, things are tough. Now, there's when the yield curve slides like this, in fact, when rates go down, let's look at rates just on their own here. Let's look at the 2-year here real quick. Actually, I can go to risk ranges for my 2-year. Easy to find. Right there at the top. So, there's been a lot of selling in bonds up until this past, sort of recent high here in the middle of the month of June. And it looks like it might be trying to top out, trying to put in a topping formation. And as yields do this, going into recession, the market can still go just ride up very easily. So, it's definitely possible that this bear flag that I'm looking at could be a bottoming pattern. This could be the start of another leg higher as we go into recession, which is what the market will do. The market will do that. The market, it'll do that. It'll do anything, But it's a matter of, it's an eventuality, though, that it starts coming back down and coming down rather quickly. So my bias is to the short side, and I am willing to play the long side. I am willing to be contrarian of the overall trend if on that day, on days like these, it's going to be profitable to be contrarian. I will certainly do it. So as of right now, the setup is, the short-term setup is bullish. I think that I'd probably look for a pullback close today if I were going to get into a bullish setup. I'd look for a pullback close to 287, roughly in the 287 area for support. But you never know. I mean, we could get another one of these candles over here that happened on like the 28th of June and could just break down big time. Who knows? Well, for today, though, I will be, my bias will be to the long side. I will look for oversold conditions. In fact, actually, it looks like we're going to open up coming out of overbought. That yield curve, let's go back to the indicators. A heightened negative yield curve like that, and the VIX being elevated. Let's go back over here to the VIX. an elevated VIX, a VIX that's breaking down too, though. Yeah, the VIX is oversold. Imagine that this morning at the open, there's going to be a little bit of sell-off at the open, and then it just seems like after 10:30 or so, somewhere around 10:30 to 11 o'clock, the buyers just have been coming in and saying, okay, this has been peak inflation. Rising interest rates are generally good for the economy, and they are. Not good for the stock market necessarily, but yeah, it's really quite possible. Buyers could just come in and kind of roll things up. So, personally, of course, my bias is the downside. I think this is the next leg into a bear flag, but we'll see. All right, everybody. Good luck out there. Keep your risk tight. Click like, share, subscribe, leave a comment, tap the bell, and I will see you on Monday morning's on Monday morning's strategy session. Have a great weekend, everyone. I am out.